Welcome to the India FinTech Diaries, the only podcast focused exclusively on the Indian fintech market. I'm Elroy.
And I'm Hemant. In each episode, we dive into the latest trends, ideas, innovations, business models, and personalities that are shaping India's fintech landscape.
We also invite amazing guests who are innovators and industry players that are driving the change that is helping make financial services more modern, innovative, and inclusive in India. Come join us as we explore the changing landscape of fintech in India.
Welcome back to India FinTech Diaries, your one stop destination for stories from the cutting edge of India's thriving fintech ecosystem. I am Hemant, and today we have a fascinating episode lined up. With me is my co host Elroy.
Hemant, very recently on May 22nd, in fact, literally this week, the Hong Kong Monetary Authority passed a stablecoin bill to regulate stablecoins. And similarly, the media has been reporting that the US Senate has advanced the Genius Act, which is a landmark bill aimed at regulating stablecoins. And just last month and early this month, both MasterCard and Visa made announcements of various partnerships and projects aimed at integrating stablecoins in their payment rails globally. With all this attention on stablecoins and crypto, we thought it's time to take a look at what all of this means for the future of payments in India. And to do this, we welcome Aishwary Gupta, Global Head of Payments at Polygon Labs. Welcome to the show, Aishwary.
Thank you so much for hosting me here.
Actually, so before we start delving into this very, very interesting topic, how about we start with you telling a little about yourself and how you got introduced to the world of crypto and Polygon?
Yeah, I think I completed my CA back in 2018, then spent good amount of time with American Express. I think American Express shaped a lot of that for me to get into crypto because working at American Express from the payments perspective, I was very closely looking at what are the nuances of why payment is still like a 40-year-old software which is there. And we were like, I think American Express was one of the early investors in a crypto company. And there were a couple of actually experiments that we were running at that time. Now, most of them are case studies, but I think that actually kind of created. So we were trying to go out and do some high end merchant cards where essentially, if you are a US or a UK merchant, you can move money instantly.
Right.
We were also trying another example where we were trying to go out and send pension to Mexico automated through crypto. So, I mean, all those things fascinated me a lot to kind of go into something which was evolving, but like was very fascinating. I started there at Amex with a couple of those experiments, then joined an Indian exchange. Exactly when like India, like I remember 2 days I was in job and India was like, there is going to be a ban in crypto. And I'm like, oh,
Yeah, I remember that time. It was completely crazy.
yes, and from that perspective, I think joined there, then joined a crypto bank in Switzerland, tried to understand more, managed like $100 million fund with them, and then like from there, I joined Polygon around 4 years back. Being here at Polygon, working on different roles, started with DeFi, so I used to teach DeFi as well. But like, yeah, overall, from that perspective, in these 4 years, evolved into multiple roles and now kind of manage a big portfolio from for Polygon across the world, which includes payments, real world assets, tokenizations. Lead a team of like 9 people now, which is almost 70% of the BD team at Polygon now. So yeah, that is where I'm now.
That's great to know, Aishwary. Let's start with the basics to lay a foundation for the rest of our discussion today, right?
Mm-hmm.
Now, if you look at the use of stablecoins, this has increased in recent years with the average supply of stablecoins increasing by roughly 28% year on year.
Mm-hmm.
And total transfer volume also is immense. In fact, it hit $27.6 trillion last year, surpassing the combined volumes of Visa and MasterCard transactions in 2024.
Mm-hmm.
But what exactly are stablecoins? And in a related question, what are central bank digital currencies and how are these two different?
Yeah, last week we also passed a big milestone on like payments, which was 1% of the total US dollars is actually now tokenized in the form of stable coins. And from the perspective of like what are stable coins, different types or different ways in which you can build a stable coin, but very basically put, stable coin is nothing but a digital representation of your currency. It could
Right.
be like the major one, or you'll say like almost 98% of the total supply, which is of the stable coins as a digital representation, is US dollar. But slowly and steadily, I think other currencies are making way in. This year itself, I think we have around 17, 18 currencies which have come up as non USD. I think one of the biggest reasons why stable coins is kind of also picking up as a digital representation is because it's much cleaner and faster to kind of move money using stable coins as compared to your conventional ways. Funny story, like even last week, one of my friends actually moved to Dubai, and he was paying like a annual rent from his
Right.
account and used Swift. Swift wrote the wrong name and his money is stuck and he is homeless since last 8 days just because the money has still not reached the landlord's bank account. So I think those kinds of instances keep on happening, and stablecoins just represents a better way to move money, kind of an innovation from that perspective, not on the money side, but the way you transact money. And on the CBDC side, I think the only difference between a stablecoin versus a CBDC is that the CBDC is directly issued by the government as a digital representation of the country,
Yeah.
and stablecoins are not actually issued by the government. Both of them have their own ways of how they can help and benefit based on how the regulatory environment is in various countries. Like there'll be some countries who will always want to depend on CBDCs. There'll be countries who will be like, we don't care about CBDCs and will be fully open. Like US is outright said that they do not want to kind of have a CBDC, and multiple states now are coming in and just outright banning that CBDC would ever be coming to US. Similarly, like there are countries like India where the way to go out is somewhere around CBDC or like a mix between a CBDC or a stable coin. I can talk more about it from a regulatory perspective as well on why this makes sense or how they all have their own ways to begin. But that is basically, as a layman, what stable coins and CBDCs are.
And I hope your friend quickly solves that problem. Dubai weather is not a weather where you can stay homeless. So I have a slightly controversial question for you, Aishwari. So UPI has clearly transformed India's payment ecosystem, but as someone operating at the frontier of decentralized infra, where do you see the current limitation of UPI, especially as we look towards a more autonomous programmable payment system? And if you're imagining the successor of UPI, what should India's next gen payment rail look like to support a real time global and intelligent commerce?
Correct. I'll quote a couple of examples here to like just
Right.
make it a little bit more interesting. So from a perspective of global basis, on a global basis, what happens is almost $7 trillion move on a daily basis. Now this includes your cross border. This includes transactions happening within the country itself, and almost out of that total money. So there's three categories of this money. Around 22% of this money is uninsured, which means that there is no guarantee that the money that I'm paying you, I'll get it back.
Okay.
In multiple instances, like in 2008, where a bank made a payment to a counterparty bank, and the counterparty bank either went bankrupt or they did not have the cash, so they never paid back, and there is no recourse for it. Almost 32% of the money is PVP, which means that it happens in the same leg. You're transferring US dollars to someone, the other currency will come back. There are only 18 currencies which are like insured in this manner. Then there is another 32%, which there are like contracts which ensures that money will reach you. So almost like 2.3 trillion dollars on a daily basis is moving without insurance. So that's one fact to consider. The second fact is the way you look at UPI. UPI has 100% democratized or brought the existing economy, which was already there in a way, largely in India. So it technically did not create like a massive new economy.
Right.
Even if you look at it today, the number of UPI transactions, though the number of transactions are massive, and probably there is no system in the world which is operating at the scale, but the average amount of transactions still is that of like you buying a cigarette, that you buying like a chai at a tapri. So on an average, like 100 rupee transactions. So that is basically what UPI has done. UPI has digitized the existing economy which was there. So that is the second fact. And the third thing is, like when you're looking at UPI, UPI is a message based system, which means that today the way UPI works is you feel that UPI is instant. When I'm sending you money, it feels like the money instantly got sent, but that actually does not happen at the back end. Your money actually gets settled every 2 hours, and that runs 24 by 7. So every 2 hours, there is a recon that happens. NPCI has a full team who ensures that the reconciliation is happening. Everyone is getting the money, and they run this recon every 2 hours. And even on a weekend, that's running. So that's how your money gets settled at the back end. First, the messages move, the whatever is the net amount from the messages. There is a settlement that is run, and through that settlement, the money actually moves to the bank accounts. So that is one thing. So this is something where it is a messaging network. And now this is something, these are some of the things from a Web2 perspective. And when you look at blockchain based payments, the best part about blockchain payments is it's 100% PVP, which is payment versus payment, or payment
Correct.
versus. What that simply means is, like, when I'm making a payment to you, there's a 100% guarantee that either the transaction would not happen, or if the transaction is happening, it would complete on both the legs. So, for example, let's say a protocol like Uniswap. When you go to Uniswap and you want to let's say there are two currencies, Euro and USD. The moment your USD leaves your wallet, there's an instant on the other side, the Euro will leave and it will be settled in the same leg. So there is no need for a third party to create that guarantee. There is no need for a third party to create reconciliations. So that is one fact. And the second thing is, from the perspective of how UPI is built, UPI again, like, is a messaging layer, and this is actually like a layer where the money is moving alongside. So the way I look at it from an Indian perspective is, so UPI has its own role, and UPI's role is phenomenal. With the way I see a new economy opening, so I'll give you another example here. So let's say in India, when you look at long-term loans, that's stuck capital. So when you look at
Right.
India, like when you look at the government, and the government says we should go out and become like a $5 trillion economy, there are two ways to do it. One, either you reuse the assets that are sitting in the economy and not cause a havoc with inflation, or you can simply print money to kind of go out and create more demand so that the economy grows to a 5 trillion economy. The first thing is something that you cannot do without a blockchain, because blockchain establishes itself like as a trust vector. So imagine, like, in the banks you have crores and crores. I don't know exact figure, but there probably would be thousands of crores of money which is stuck in a long term loan. And if you look at the 2008 CDS fiasco that happened in US, the product itself was not a bad product. The product became bad because the elements operating that product did not remain true to themselves.
Yeah.
So the CDS was a very beautiful product which was brought into the market. The quality of the loans which were coming in, they depreciated, and high quality assets got depreciated. So all low quality assets started coming in, and they all fell off like a ripple effect. But if you can kind of go out and imagine a word, and like if you look at RBI has been trying to create secondary markets for debentures, bonds, loans, and all these things. But it is still like very costly to go out and do that and to create a secondary demand. Using blockchain infrastructures, you can actually go out and tokenize the same long term loans, create a CDS structure, and then using that CDS structure, you can raise more money, bringing capital back to the bank, which it can go out and give it back into the economy. Now, the difference between a CDS of 2008 versus a blockchain enabled CDS is something that here what you can do is, through a blockchain, you can always be updated that whether the EMIs are getting paid of the underneath CDS real time. And because of that, there will always be a fluctuation in the price. Because let's say there's a 1,000 rupee CDS which is getting generated, and there are 10 loans, and someone does not pay a loan of 100 rupee there, automatically you'll get a alarm that someone has not paid one of the EMIs of the CDS that you're not holding. And at that point, you, as whatever is your risk appetite, you can go out, hold it, resell it at a discount, which creates those secondary markets as well. So now this is something that UPI cannot unlock.
Right.
And that's why there are tons of those examples, like gold tokenization. There's so much other like tokenization, like real estate is another thing, which is sitting idle in India and is unproductive. And the way to unlock it on the blockchain and create a payment mechanism which can unlock it is something that is missing. And UPI cannot be that, because UPI does not settle the transactions in payment versus delivery. And that is why, like, I think either India should kind of have its own stable coin, it should allow people to have stable coins, it could go out and make CBDC play that role in some ways if it is built in that sense. But I think this is not a challenge towards UPI, but this would become like a complement to UPI to create this new financial infrastructure, which is much more efficient, does not require as many intermediaries, and ensures that the money movement happens in a way where there is a minimum friction, and maximum transparency.
Aishwary, double clicking on that a little, right? What Indian use cases do you think are most ripe or ready for stablecoin adoption today?
Three of them which like are on top of my list. One is cross border payments.
Right.
If you look at India does, along with inward outward remittances and trade volume, it does around $1.8 trillion annually.
Yeah.
And we spend on an average, so based on like number of transaction, less than 200, more than 200, more than 500, the average cost of transaction in India, including all the ways, is around 4.8%. That's $84 billion that India is spending to move $1.8 trillion. And that is something which is massively high for someone who, and since like most of these transactions happen in a low ticket volume through banks, the cost of moving money is like more than 10% sometimes. And this is like one use case which, even if enabled in a way, can go out and help reducing this cost massively. So I think that is the first use case which is there, which is like on top of my mind. The second is like, I think from a perspective of tokenization and payments, which is tokenization of assets, primarily like real estate,
Okay.
long long term loans. I think that is the second thing. And the third thing is an open banking framework. So imagine today, like when you go to a bank, let's say you have a banking relationship with hypothetically HDFC. You have like an fixed deposit in HDFC, which is giving you a 6%, and the fixed deposit is worth 10 lakh rupees today. Now, if you want to go out and take a loan against it, the one thing that you will do is you cannot go out and use this fixed deposit as a collateral in different banks,
Right.
because your FD is sitting in HDFC. And that means, as a consumer, I am not getting the best out of it. Why? Because I'm 100% sure there is a bank out there which would want to beat, like let's say, overdraft limit that I want to borrow against this FD at whatever rate that HDFC wants to give me. And that's something which is very close, and it's not an open banking. So for a customer, it is very difficult. Now imagine when you talk about agentic frameworks, you can create a mechanism where you just can tokenize this fixed deposit, put it on a blockchain, and say, this is a fixed deposit that I have in HDFC, and I want a loan against it. And there are 20 agents of banks, AI agents of banks, going out, looking at this position, and trying to bid and say that we are okay to give you an overdraft limit of this amount at this rate. Now, that is something where the consumer wins. Right now, the consumer doesn't win. That is like the third thing, which is going to be a massive thing if we can kind of go out and unlock this with the entire blockchain, AI framework, and stablecoins.
Actually, you earlier touched upon, and Elra also spoke about some of the regulatory and commercial adoptions that stablecoins have received outside of India. Now, in your opinion, what kind of regulatory clarity is needed in India to make INR-backed stablecoins viable and accepted?
I think the biggest challenge is from a perspective of India. India needs to a little bit more deep, in-depth analysis of why
Right.
and a stable coin be built in India. Like
Mm-hmm.
when you look at US dollars, US dollar is freely tradable. But when you look at INR, because of the LRS rules that are there, which prohibits every person with like each PAN card to move up to $250,000 a year, with some exceptions, it is very difficult to kind of go out and make a freely tradable stablecoin in India, because you will not be able to control a freely tradable stablecoin in India with the rules that essentially are there in RBI and the Prevention of Money Laundering Act. And hence,
Right.
what you need to do is like you need to either go out and create a, you can say, semi-open, like which is like you still control who is moving how much money in a digital format. Can that be done? Yes, that can be done. But because the licenses, like there are multiple licenses which RBI issues, and none of them mention how to regulate it, it is very difficult to kind of go out and find out like whether you are in the gray area or this is something that the central bank would not want. So that is a big challenge which is there, and that is why one of the things, or one of the ways in which I see it, probably like personal opinion, is if I can go out and get a wrapped version of the CBDC,
Yeah.
enabling semi kind of transferability, and that would kind of enable it. It just needs a mechanism. So coming back to your question, like what needs to be changed, I think the first thing is how the banking would support it. Because today, when you go to a bank and say we want to launch a stable coin, they say we are not going to give you a banking facility. So it's very difficult to go out and do that. You cannot bring a foreign bank into India to do that, because the moment you bring a foreign bank, or like you want to own a foreign bank to go out and do that, the rules kick in of the Banking Regulation Act, and you cannot do that. And the third thing is, there is no clarity on how you can move that money, because RBI has the sole discretion to kind of go out and use money, or you can say print money. It is very difficult for anyone to kind of go out and tokenize it without their permission. So I think that is something where we need to kind of go out and have amendments in three laws, majorly at least. The RBI Act. The second one is on the side of composability of CBDC, or like enabling us to create another stable coin with the banking rails. So something in the banking act. And the third, from a perspective of on the side of like how they will treat it, because today if they treat it as a money, it is very good, but the moment they treat it as a commodity, there will be GST implications. So the
Right.
benefit, cost benefit that you get into it will all be gone, because if someone says like, if you're paying me in stable coins, you need to pay 18% GST, nobody will use it.
Shifting gears a little bit, Aishwari, another hot emerging trend, and you touched on this a little bit as well, is agentic commerce. And we're seeing very early examples of AI agents booking travel, reordering inventory, or scheduling service renewals on the consumer side of things. Now,
Correct.
what kind of payment infrastructure is needed to support the shift in India?
I think it's the same thing. So what you're talking about is something like an example that I was doing last week itself.
Right.
There's a company called Crossmint, which is I think a US based company, and they've built all these agents where you can kind of go out and create automated subscriptions, or you can go out and buy automatically on chain. For this, essentially, you cannot leverage the existing banking rates, because for this, like, you need a lot of that tech to be built, where the trust is getting created when the money is moving and how the money is moving. So I
Yeah.
think even for these things to actually become successful, there needs to be a way where the money can move on the blockchain, because now you're entering into areas where you do not have control. When you do not have control, there needs to be a way in which you can always ensure that what went wrong if something went wrong. And because there are multiple parties involved, having a system which is currently there in the banking system, it would kind of require a massive amount of uplift to create that kind of, like, you can say, mechanisms to go out and create these agentic frameworks. So we are testing this outside India a lot. Like, there are bots who will, like, AI agents who would enable you to go out and manage your portfolio. Like, we're working on a product with a very big bank in US, where what they want to go out and do is they want to create a framework of investment. So you get
Right.
your salary on a 30th in stable coins, and you say, let's say I want to allocate 30% of my salary in investments. You go out and create the categories in which you want to invest. And just like robo advising, I think robo advising did not take off earlier, basically because of the way the investing happened. Everything was not open source, the money was not moving clearly. But now what you can do is, through this agent, it can go out, and if the assets exist on the blockchain itself, which to a fair amount now exist, you can actually just tell your agent as a robo advisor that this is where I want to invest, this is where my portfolio should be, you should rebalance if these ratios change. I think those things are coming in, but the biggest challenge again is these things require much more open rules and regulations as compared to what they are in India right now.
Aishwarya, I think a related question is that typically, if you see blockchain transactions, right, they're a lot slower than what we're used to as far as both agentic commerce and actual commerce is concerned. What role do you see scaling solutions, especially those like Polygon's ZKVM, playing in this new wave of commerce?
I think, yeah, back in like 2017, 2018, when we had like Bitcoin and Ethereum, the transaction speed was something that was not comparable. But
Correct.
from perspective of, like, I think when Polygon got into the picture, it was basically to scale in a way of a side chain, like enabling people to kind of go out and do the transaction faster at a cheaper rate. And like slowly and steadily, that is evolving as well. Like today, when we are kind of going out and we are working with a lot of these companies which have millions and millions of users, the biggest thing is now that can be done. And why that can be done is because constantly, one of the biggest things that I love about public blockchains is that the innovation in public blockchains is happening at a speed which is very, very fast. Why? Because you're
Right.
not reinventing the wheel every time. In Web 2, the biggest challenge was If you have Paytm, PhonePe needs to be created. It cannot use the Legos of Paytm to go out and create PhonePe. But here, the biggest benefit of a public blockchain is you see someone else who's open source building the tech. If that tech makes sense, people will adopt it and make it much better from their perspective. And that is exactly what is happening even at Polygon. Like we started at the initial, like we had around 7 transactions per second. This month end, we would achieve like 1,000, and like by the end of this year, we'll be around 10,000 transactions per second. For reference, like if you look at Visa and Mastercard, they
Yeah.
they have a high throughput, but on an average, Visa and Mastercard process around 3,000 to 4,000 transactions per second, which means that the tech is scaled to that level where these things can happen within a second, sub 1 second as well. And it is at par with the way the current ecosystems work. This is something where you need to look at it from a perspective that, like when you look at web 2, and when you look at like when you're opening a website of Apple or Samsung, at the back end you have multiple data servers from where the data is getting in, but when you
Yeah.
see it, you don't realize that at the back end there's so much going on. And I think that is where we are going. These chains individually will kind of go out and create that kind of a high transaction throughput. Multiple other chains together, when they come in and it will reach that level, we have that scalability now. So I think tech is no more like a kind of a big challenge anymore, like how we will reach these kind of level of transaction outputs.
Aishwary, you touched upon CBDC initiatives in India, and RBI has been very focused on this. Its digital rupee pilots have also been very encouraging. How do you see CBDCs and stablecoins coexisting in the Indian ecosystem, particularly when it comes to automation, interoperability in particular, and smart use cases?
Very simply put, like when you look at CBDC, CBDC is built on a system called Hyperledger Fabric. Now, when I was
Right.
talking earlier with you on delivery versus payment, or like payment versus payment, PVP or DVP, the biggest challenge for the system which RBI has created, it can go out and settle PVP very easily. And that is why like they're going out and they're having like all these benefits which the government gives, or employee salaries or employee bonuses being given out in CBDCs. The challenge is the assets do not exist on Fabric, which
Okay.
means that you cannot create a delivery versus payment on the Fabric system until unless RBI comes in tomorrow and says we are going to be the asset issuers as well. Which means that they will say, like, if for a bank they want to issue an asset, RBI will issue that asset and it would be on one single platform. It can happen. It's not like an impossible task, but it's gonna be an uphill battle, mainly because of three reasons. One, nobody would want to go out and give you the rights to issue the ownership of that, like tokenize that asset, if the asset does not belong to you. That is like a fundamental challenge that is going to come in. If I want to tokenize gold and I have gold at my home, I would not want you to go out and tokenize my gold. I would want myself to tokenize that gold.
Right.
The second thing is from a perspective of the talent that is required, and this is the problem with a lot of closed systems. The talent to pull this kind of an effort is massive. And since on private blockchains, the talent is like very, very, very less, probably like 1/20th of how much, because of salaries, because of opportunities and whatnot. The talent pool is very small. And if the talent pool is very small, it's gonna be an uphill battle for them. And the third thing is from a perspective of going out and improving constantly. Now, in the like I said earlier, also when you talk about public infrastructure, everyone is raising money and is building public infrastructure. So there is, and everyone is using each other's Legos. When you go out and as a central bank try to do that, then you need to innovate at the pace you are challenged by the entire world, which is like going out and developing together, coexisting, as compared to you putting the money to reinvent or like go out and make those systems much more efficient. So I think these are three fundamental challenges where what will happen is like CBDCs would play an important role. They would be an important aspect when you come for interbank settlements. Like today, there is hundreds of crores that is getting settled through wholesale CBDC. And that is where like the banks would kind of go out and do that. But when it comes to assets that are not owned by RBI, it's gonna be like a challenging thing. And that's where like I think either a wrapped version of CBDC or like which can go to other blockchains to kind of go out and take over the assets, or from a perspective of stable coins which would come in and kind of go out and facilitate that. That is something where both these systems will coexist. They will challenge each other in some ways or the other, but technically, because both of those systems are in a way built on the same technology, they kind of inherit the same terminologies or the efficiencies. You can program it like, so RBI has a PCBDC which they rolled out, I think 2 3 weeks back. I don't know what happened after that, like how much has been issued or not, but they want to kind of go out and do that. But the innovation will always be kind of be slower on this side because of the three reasons that I mentioned.
Actually, Polygon has worked on the interoperability and scaling globally. And India, by the nature of its volume, has a way of testing out any technology for scalability. So, in your opinion, what are the lessons or infra learnings that could be relevant to India as India prepares to launch programmable payment rails that support people and agents?
I think the way, like, so I work with around 7 governments across the world
Mhm.
Right.
at different levels and different ways. And one of the things that I'm seeing is from a perspective of most of these governments, they are kind of like yesterday, like 2 days back, we had this whole Hong Kong government actually coming out with that. And yesterday only, we received an email asking us to kind of go out and share a lot of those findings that we have had in an invitation to us so that we can go out and contribute. I think that
Mhm.
is not happening in India. That is where like the biggest challenge is. Like I can go and approach multiple governments and probably I will be able to go out and I will be able to get them to talk to me within a day or two. But when it comes to India, I think that is one of the massive challenge. Who do you go to and talk to? That is one. And the second thing is from a global perspective, I'm seeing a lot of these governments actually kind of going out and saying that we want to regulate these things that you want to build with the industry partners. And I think the other thing that is happening in India is we do not know where the regulation is coming in, where the Supreme Court, like I think last week said that they want to kind of go out and they want the government to regulate. But when you look at and when you try to go out and see how internally it has to be done, there is no clear path. And so a way in which like this clear path can be established for engagement or how this can be done is something that would kind of help India a lot on how actually you can go out and build those systems. But from a global perspective, that is one of the top thing, how easily it is that you can go connect with the government, share your thoughts, go out and enable a pilot. Like we have done tons of pilots with Singapore government. We've had like where we go back and forth. A lot of those examples never work out, but at least the government is open to kind of go out and do those things. And that is something that is missing. So there is no sandbox, there is no way in which people can test it out, try it out. We tried once, like in India, with the Telangana government, and the number of rules that needed to be amended, the number of the even from a government perspective, I would not say it was impossible, but it was like quite difficult to find ways in which those amendments or these bodies would interact to go out and do those amendments so that any of those things that are happening globally can happen in India.
Let's fast forward a bit, Aishwari, to 2030. What would, in your mind, India's payment stack look like in the future? Is it UPI 3.0, CBDC powered network, or something entirely that enables the next gen of commerce natively? And just a thought experiment. What's your view on that?
I think the current way in which UPI operates will operate because it's a massively scaled system and it works. But from that perspective, like I think the efficiency would still be required. So 2030, the way, if I feel like the regulations open up, the
Mhm.
way would be either the stable coins or CBDCs going out and enabling cross-border payments or like movement of money whenever it comes to moving money outside India. Second, programmable money would empower a lot of those agentic frameworks, a lot of that open banking that should be there. And what will happen is UPI might also go out and build like a system where I don't know, like if you've ever heard of like Bitcoin Lightning Network. So
I have,
Bitcoin
yeah.
as a network, actually, you do not want to go out and transact on the Bitcoin network because it's expensive, it's slow. So what people do is they kind of containerize like a Bitcoin as a security and then create like a Lightning network, which is where you can transact very fast, very cheap. And then what happens is a summary of those transactions actually just evolve and get pasted to kind of go out and have like the netting impact. So I think UPI can also go out and evolve in that system if it wants to move away from just being a messaging system to being like a actual message plus payment system. Like even today's the way CBDC is designed, it works in a very different manner as compared to how blockchain payments work. Today's Indian CBDC works on two rails. They have a messaging layer and they have a settlement layer. If we need to kind of somehow find ways to merge this, if this merges, so that is where like I see UPI would evolve in not being a messaging system but being a system where you can have these small containers of trust, just like UPI family accounts or UPI circle of trust. You're moving money mostly into those circles, so that is kind of off chain, and only those transactions when they're netted they come on chain, or you move from one container to another. That is how UPI evolves. You see the another stack which is on the CBDC side, which is composable with all the blockchains, and is also like seeing some of those stable coins emerging to kind of go out and make a perfect stack for India to move globe money across the world or within India seamlessly.
Aishwary, it's been a pleasure having you on the show. Thanks a ton for insights into this brave new frontier of payments.
Absolutely, it was a pleasure to be here. Thank you so much for hosting me.
It's been a pleasure having you on the show, Aishwary. And to our listeners, thank you for tuning in to another episode of India FinTech Diaries. If you enjoyed today's discussion, don't forget to subscribe and stay updated on the latest in India's fintech landscape. And do visit our website, indiafintechdiaries.com, for show notes and other exclusive content. Until next time, stay safe and stay curious.